Hello and welcome. Today, we're going to talk about something called supply chain finance. It's a really powerful financial strategy that's changing the way businesses, both big and small, handle their money. So, let me start by asking you something that, well, it sounds like a bit of a riddle. What if a company could pay its bills later, improving its own cash situation, but at the very same time, its suppliers could actually get paid faster? It seems like it shouldn't work, right? But this is the exact problem that supply chain finance is designed to solve, and it does it brilliantly. You see, for pretty much any business out there, managing cash is a constant juggling act. So much of your money can get tied up in the day-to-day stuff, inventory sitting on a shelf, or waiting for customers to pay their invoices. This can really put a strain on things, and most importantly, it can hold a company back from growing. So my goal for you today is to pull back the curtain on how this whole thing works. By the time we're done, you'll have a really clear picture of how supply chain finance manages to unlock cash, not just for one company, but for everyone along the supply chain. It really does create a healthier situation for all. All right, so here's what we'll be looking at. First, we'll talk about the working capital problem itself. Then I'll introduce supply chain finance as the solution. We'll see how it actually optimizes cash flow, look at some of the specific tools used, and wrap up with the wider impact it has on businesses.
Okay, so first things first. To really get why the solution is so smart, we need to understand the problem inside and out. And that's the challenge of managing something called working capital. So what is working capital? Well, in simple terms, it's the cash a business has on hand for its daily operations. Think of it like this. Take all the stuff you'll soon turn into cash, your current assets, and subtract all the bills you have to pay soon, your current liabilities. What's left over is your working capital. And a healthy business absolutely needs to have a positive number here, just to keep the lights on. This analogy is just perfect. Cash really is the lifeblood of a company. It needs to keep flowing to keep everything running smoothly. If that flow slows down or gets blocked somewhere, the whole business is in trouble. And this can happen even if the company looks profitable on paper. So, how do we measure how efficiently this cash is flowing? Well, there's a key metric for that, and it's called the cash conversion cycle, or CCC for short. It's basically the number of days it takes for a company to turn its investments in things like inventory back into actual cash from sales. And as you can probably guess, the shorter that cycle is, the better. The cash conversion cycle is made up of three main parts. First, there's how long your cash is stuck as inventory before you sell it. Second, there's how long it takes for your customers to actually pay you. And third, there's how long you take to pay your suppliers. The goal here is pretty straightforward. You want to make those first two parts as short as possible. And the third part, well, you want to make that one as long as possible. Okay, so now that we have a solid handle on the challenge of that cash conversion cycle, let's look at the modern solution that's designed to fix it: supply chain finance. Supply chain finance, or SCF, is basically a set of tools that help manage the money moving through an entire supply chain. It's not just about one company's finances. It's about making the whole network of buyers and suppliers financially healthier. There are two things that make SCF really different from, say, a normal bank loan. First, it's event-driven. This just means that the financing is connected to a real specific thing that happens, like an invoice getting approved. Second, it's technology-enabled. This whole system relies on a digital platform that connects the buyer, the supplier, and the finance provider, making sure everything is visible and secure for everybody involved. And this brings us right to the core of how SCF actually works. It's all about creating what we call a win-win situation that solves a very natural conflict in business. Just think about it for a second. In any normal transaction, the buyer always wants to hold on to their cash as long as they can, right? They want to extend their payment terms. But the supplier, they want the complete opposite. They need to get paid as fast as possible to keep their own business running. These two goals are, well, they're in direct opposition to each other. A great way to picture this is like a seesaw. If the buyer pushes their end up by paying later, the supplier's end automatically gets forced down because their cash is tied up for a longer time. Supply chain finance acts like the fulcrum, that balancing point in the middle, that lets both sides get what they need. So here's how it actually creates that win-win. The buyer gets to negotiate longer payment terms, which is great for their cash flow. But at the same time, the supplier is offered the chance to get paid early by a financing company. Now, here is the absolute key to the whole thing. The financing for that early payment is based on the buyer's credit rating, which is usually much stronger, not the supplier's.
This means the supplier gets access to cash way earlier and at a much cheaper rate than they could ever get by themselves. See? Both sides win. This win-win is made possible by using a few specific financial tools. And these tools usually fall into one of two buckets, one started by the seller and one started by the buyer. On one side, you have seller-led solutions, like factoring. These are all about helping the supplier get paid faster. On the other side, you have buyer-led solutions. These are started by the buyer who wants to make their own payments more efficient while also helping out their key suppliers. A really classic example of a seller-led tool is factoring. This is pretty simple. A supplier sells their unpaid invoices to a financial company, a factor, at a small discount. The supplier gets their cash right away, and the factor is the one who then collects the full payment from the buyer when it's due. Now let's look at the most popular buyer-led tool. It's often called Payables Finance, but a more descriptive name is reverse factoring. Here's how it works. A large buyer with a great credit score sets up a program with a financier. As soon as that buyer approves a supplier's invoice, the financier steps in and offers to pay the supplier immediately. And because it's backed by the buyer's strong credit, the interest rate is really low. This is the main engine behind that win-win we keep talking about. Okay, so the benefits of these tools go way beyond just making the numbers look better on a spreadsheet. They actually have a really big stabilizing effect on the whole business ecosystem. SCF makes the entire supply chain stronger and more resilient. Let's say you're a big car manufacturer. What if a small supplier who makes a tiny but essential bolt goes out of business because they ran out of cash? Your whole assembly line could shut down. By giving that small supplier access to affordable cash, SCF lowers the risk that they might fail. It's a huge deal. And for the buyer, this kind of financing is typically not treated as debt on their books, which helps protect their own credit rating. And it's so important to understand that none of this would be possible on a large scale without technology. These days, digital platforms handle the whole process, from purchase orders to invoice approvals to the final payment. It makes everything fast, transparent, and super efficient for everyone. Technology is really the engine that makes all of this work. All right, to make sure these ideas are really sinking in, let's quickly go over a couple of common questions that usually come up. First off, a lot of people wonder, how is this any different from just getting a regular bank loan? And the key difference is this. A traditional loan is based on a company's general creditworthiness, but SCF is tied to a specific transaction, an approved invoice for goods or services that have already been delivered. The financing is for a payment that's already been confirmed, which makes it a much lower risk for the lender. Okay, and let's circle back to that main technique, reverse factoring. What's the number one benefit for both the big buyer and the small supplier? It really comes back to that perfect win-win. The large buyer gets to improve their working capital by holding onto their cash longer, and the small supplier gets to improve their working capital by getting paid much, much earlier and at a great financing rate that they could never get on their own. It just optimizes the cash flow for the entire relationship. So let's just quickly recap the main takeaways. First, working capital is the cash that keeps a business running, and it's measured by the cash conversion cycle. Second, supply chain finance is a strategy to make that cycle better by solving the natural tension between when buyers want to pay and when suppliers want to get paid. Third, it lets buyers pay later while suppliers get paid sooner. And finally, none of this works without technology to provide the visibility and automation needed. And that brings me to a final thought to leave you with. As technology like AI continues to advance, you have to wonder, how are companies going to use these SCF tools to build financial ecosystems that aren't just efficient, but are truly collaborative and intelligent? Now, I'd love to hear from you. What's been the biggest hurdle you've faced when it comes to managing cash flow, whether it's in your own business or even just in your studies? Go ahead and share your thoughts in the comment section below. If you found this guide useful, we'd really appreciate a like on the video, and make sure you subscribe for more guides on important business concepts. Thank you so much for your time today.